Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update. And so looking at the S&P 500, we are still in Market State 2. Market State 2 is one of the 5 bullish market states, which means that it has a little bit lower risk. However, I will say this, the market is kind of approaching resistance, and we've already seen sort of a significant rally, so we could see some sort of pullback here, especially since short-term supply and demand indicators are still negative. Canterbury Volatility Index measures CVI 69. Volatility is kind of continued to decline as the market sort of flattened out over the last 2 weeks. And if we look at short-term volatility, which is a 10-day Canterbury Volatility Index, that actually measures CVI 40, meaning that it's fallen sharply off of its highs. And as it enters that extreme low, anything below CVI 45 is considered to be extreme low. You could see a market outlier. And we've talked about this in the past, whereas volatility gets squeezed down like a spring, you're more likely to see a pop in volatility. So that is something to keep in mind for the next coming days or the next coming weeks. And if we look at the market, it's continued to show us where its support and resistance is and where its trading range kind of enters into. And so if we look at this chart, we'll kind of explain support and resistance. So support and resistance are where supply and demand shift. So at support levels, which are at troughs, demand takes over, and then at resistance level, which are closer to peaks, supply takes over, and they kind of fluctuate in between support and resistance lines until the market decides to break one way or the other. And so at point A, we get some resistance established at line 1. Point A is where the market's at a peak. It then follows all the way down to point B, and you can see it established as a line of support at line 2. And from this point, it rallies back to line 3, which is going to be a new line of resistance, and then begins to fluctuate between lines 2 and 3. So it's fluctuating between support, between resistance. Finally, at point C, demand is strong enough to break through line 3 or break through that overhead resistance and rally to point D, which is now back at line 1, which is again overhead resistance at this point. From here, it sort of falls back and it's since then pulled back to point E, which is at the old resistance line, which has now become support. So you could either expect this to sort of bounce off of this support line and rally back to the overhead resistance line and continue to fluctuate in between those, or maybe supply takes over and we actually break that line and continue downward. But only time will tell us. It's really hard to predict which way the market's going to break. And that kind of brings us to the next thing is the current sector rankings. If we're looking at our risk-adjusted ranking metric, which is a volatility weighted relative strength, utility, staples, and real estate are currently leading the market in this bullish market state on a risk-adjusted basis. And we really wouldn't expect that. We'd expect things like technology or discretionary to be carrying the market, but that hasn't really been the case. It's been more utilities, staples, real estate. Looking at the Canterbury Portfolio Thermostat, we do maintain an efficiency score of 90. Again, anything between 70 and 100 is considered to be efficient. Benefit diversification is higher at 56% because the market is in that trading range and we don't want the market to break to that downside. We want to maintain a stable portfolio throughout that. So we do hold a couple inverse positions for stabilization, but we also hold some of those top ranked sectors that we were mentioning earlier. And again, that'll keep our volatility low and our downside risk low as well. So bottom line, market is in that tight trading range. It could break to the downside, could break to the upside. No way to tell. Short-term volatility is at an extreme low, so one way or the other you could see some outliers. And that brings us to the portfolio thermostat. We want to maintain an efficient portfolio in bull or bear markets. So whether the market goes up from here or goes down from here, we want to maintain an efficient portfolio to limit risk and compound returns. Thank you, and I hope you have a great week.